Americans For Fair Taxation presents the Weekly Chairman's Report, written by Steve Hayes, president of Americans For Fair Taxation, and recorded by Bob Paxton, a volunteer with the Florida FAIRtax Educational Association. And now, this week's Chairman's Report.
Hello, I'm Bob Paxton with the AFFT Chairman's Report for Friday, May 24th, 2019. This is a study in punishing Gold Star families. A May 10, 2019 article by Laura Saunders in the Wall Street Journal revealed yet another one of the many problems with the complicated and confusing income payroll tax system that the swamp and their cronies in Congress wish were still hidden from view. Ms. Saunders points out, Rebecca Hedding's husband, U.S. Navy Senior Chief Petty Officer Gary Heddings, died of a heart attack at age 39 in 2017. After Mr. Hedding's death, his 6-year-old son began getting a $29,300 annual survivor's benefit paid to many families who have lost active duty service members. Now, this 6-year-old kid ended up owing nearly $7,000 in federal taxes on that money, a rate of 37%. Meanwhile, his mother earned $55,000 and her income tax rate was just 12%. James Conniff, an accountant in Boston, says he has a 16-year-old client whose mother died of cancer in her 40s, leaving him real estate income of about $36,000 a year. With it, he pays rent on an apartment for himself and his father, who earns around $41,000 annually as a retail worker. For 2018, the father's top tax rate was 12%, while the child's rate was again 37% due to the kiddie tax. And the child receiving taxable aid for college could wind up in a much higher bracket. So just what is this kiddie tax and why do we have it? Like many bizarre outcomes created by the present income payroll tax system, there was a problem that the 1986 reform was supposed to correct. Many people earning higher incomes and paying between 40 and 50% income payroll tax rates per year were looking at the real costs of educating their children. According to a study done by Demos, average tuition in 1980 at public four-year colleges was $2,100, $9,500 at private four-year schools. In 1980, the employee side of Social Security was 5.08%, 7.05% for self-employed workers. So, if a family had an income tax rate of 40% and were employees, they had a combined income payroll tax rate of 45.08%, 47.05% if they were self-employed. This means that the employee would have to earn $3,047 to clear that $2,100 needed for tuition, or they'd need to earn $13,782 to have the $9,500 for a private school. A self-employed person would have to earn a bit more, $3,088 to net $2,100, or $13,970 to clear $9,500. However, folks figured out a way to let their children earn their own college money and be taxed at just 10%. Doing it that way, the child would only have to earn $2,310 to net the $2,100, or just $10,450 to bring home $9,500. Of course, that's just talking about tuition. If the child was actually going to college, it was quite likely the total costs were much higher because of the cost of books, room, and board. Now, tax advisors develop techniques to have children receive income, pay less tax, and pay their own tuition and other college costs at a lesser cost to the parents. Now, this advantage is even greater if the parents could find a way to make the money transferred to their children deductible. For example, if a doctor was able to form a lab that was owned by his children's trust and then pay for lab services from his business, this advantage increased even more. Instead of taking that income from his practice, paying income payroll taxes on it, and then using the net to pay for college expenses, the doctor could deduct the payments to the child's lab as a business expense. This means that instead of having his dollar reduced to 53 cents after personal income and payroll taxes, the doctor passed that dollar on to his children instead. They pay just 10 cents tax on it, leaving the child 90 cents on the dollar after taxes instead of the 53 cents the parent would have left. That is a staggering difference. Of course, if you were not able to take advantage of these tax planning benefits, that was considered unfair. So along comes the kiddie tax. In 1986, Congress decided to stop this obvious abuse and passed a kiddie tax provision that said investment income earned by children under 14 was partially tax-free, then the balance was taxed at the parent's income tax rate. Now, all that did was cause people to delay transferring investment income to children until they became 15. So, in 2006, the age was increased to 18. Then in 2008, the age threshold further increased to cover children through age 18 and full-time students through age 23. Now, to be considered a full-time student, a child must be enrolled full-time in a school for at least 5 calendar months in the year. Until 2017, the children receiving investment earnings up to the stated ages were taxed at their parents' income tax rate. In 2017, the geniuses who write the tax laws decided that the present law was just too complex and decided to make it simpler. So the 2017 overhaul switched this kiddie tax rate from their parents' rate to trust tax rates. Now, those trust rates reach 37% when the child's income exceeds $12,751. This is why you have children of moderate income parents who may have inherited some income-producing assets or received them through a program like the one for children of deceased active duty service personnel. That's why these kids are paying a tax rate of 3 times the rate of their parents. In conclusion, instead of this kiddie tax nonsense, let's look at the difference the fair tax would make. The income received by children would only be taxed when actually spent on new goods and retail services. Money spent on education would not be subject to the fair tax. Families get all of their income, not reduced by income or payroll taxes, and then they can use those dollars to pay for their children's education. Under the fair tax, $1 of education costs $1, while under the income payroll tax system, one has to earn a minimum of $1.20 to have $1 to spend on education. Of course, the swamp is embarrassed, not because they feel like they've done anything wrong, but because the problem with the kiddie tax has been exposed. Now, they really don't care if the present system makes education more expensive. Their highest priority remains protecting the income payroll tax system because of the income it generates for themselves and their cronies in Congress.
This has been the Weekly Chairman's Report, written by Steve Hayes, President of Americans for Fair Taxation. Check back every week for news and information about the fair tax, and learn why the fair tax should replace our antiquated federal income tax system. If you'd like to receive a copy of the Chairman's Report in your inbox every week, sign up at fairtax.org or bigsolution.org.